Today's Talk About It Tuesday question is dollar cost averaging a good investing strategy? So let's talk about what dollar cost averaging is. So it's an investment strategy when you want to invest in a stock or a fund, like a mutual fund or an index fund or an ETF, and it's a buying strategy. So normally, as an investor, what you would like to do is buy low and sell high. Unfortunately, most people are emotional investors and they tend to buy funds or stocks when they're going up and they tend to sell when they drop, which is obviously a bad strategy, but most people can't get over the impulse to do that because as humans we're emotionally driven. Even a lot of investors have a hard time being disciplined when it comes to that. As a seasoned investor, what you normally do is you pay attention to changes in the entire market, changes to the entire economy, changes to particular companies, and periodically you rebalance your portfolio, meaning you heavily weight your portfolio on things that are going to go up or be sustainable, and you reduce things that are going to lose, not when they've lost, but before they lose. And you are very strategic so that you have a positive outcome. Most people can't get over the emotion. Most people are not knowledgeable enough to understand the market to that degree, and most people don't really want to put in the work like that. And so they'd rather just set it and forget it. And so you do what you call dollar cost averaging, meaning you have a set amount and a set time where you will invest in that stock or that fund periodically, consistently. So let's say it's the first of the month and you do $100. You're going to do $100 a month, regardless of how the market is doing, regardless of how the fund is doing. You're going to do $100 a month consistently. And what that does is it mitigates the risk of volatility sometimes, right? Because it's going to go up and it's going to go down, but it usually goes up more than it goes down. So if you're consistent, sometimes you're getting it at a good price, sometimes you're getting it at a bad price, but it averages out to be better than what you paid for it. So that's dollar cost averaging. And so is it a good strategy? It's not the best strategy to maximize your return. The best strategy for maximizing your return takes a lot of work and requires you, again, to really study the market, rebalance your portfolio periodically to get the maximum return. So if you're not trying to get the maximum return, but you want to get a good return, then it's a good strategy for most people, because the best strategy is going to be the one that you stick to that gives you a positive return. And consistency is the key. And more people can be consistent, just whatever the number is, $100 a month, every month, first of the month, as opposed to somebody who's more strategic and they're enthusiastic in the beginning, they fall off at the end. So in terms of consistency, it's a good strategy. In terms of a long-term positive outcome, it's a good strategy. It does not substitute for a poor fund or a poor company. If the company is bad, then dollar cost averaging is just not going to work. If a fund is bad, it's bad. So you still have to know that it's a good company that, ride like index funds that ride the trend of the market, right? They go up and down, but they're up more than they're down. It's a good strategy for consistency for the average person who has average knowledge and average skills and average time to be able to commit to it. But it's not the best strategy to get the best return. So yeah, for most people, I'd say dollar cost averaging is the way to go, unless and until you want to, learn more and commit more time to it, and then you'll be a little more strategic in your investing. So I'd love to hear your thoughts on it, your experience with it. Please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.